Hey everybody, it's Mark Pruitt with another strategic market update. I hope this video finds you well. Grab your pencil and take some notes. There is a lot going on. In fact, I've got my notes in front of me here on the computer. I'm going to make sure I try to stay on track and then give you some good information in a simplified version, and then try to bring this home and how it affects you and your accounts and your money. First off, I'll just make you aware, in case you are not, the Fed has already raised rates a half a point in May in regards to the interest rates. And so that's something we're going to talk about, and kind of what does that mean and what's the purpose and where are we going with that. And the first thing I'll tell you, there was a great interview with Sam Zell, who is a billionaire real estate investor, and he has a lot of insights. He has his feet in a lot of different things within the economy, so he gets to see a very broad range of kind of what's going on. I'll encourage you to look at that interview that will be popped up on the screen here. That'll give you some insight. I would encourage you to listen to the whole thing. It's a good interview to kind of give you an overview of what's going on nationally in regards to the economy and interest rates and all those type of things. But it's interesting, the Fed has raised that half a point interest rate for the first time in 22 years. That's a long time. I mean, it's a long time. And I've been telling some people, you know, there are investors that are young enough, they've never seen the interest rates or inflation to the degree that we have now. They've never experienced it. I remember back in the 80s, I'll date myself, you know, we all saw the high interest rates and what that did to home loans. Yet you had CDs at 16 and 18% as an example. So that's, I don't think we're going back to that point, but interest rates are definitely going up. I can tell you another thing that Chairman Powell has mentioned, that they are not even considering a 75 basis point raise next month. It's possible that could be another 50 points in June and another 50-point basis in July. We shall see. Markets reacted one day up heavily and the next day down heavily. So they've been really choppy. The best way to look at that is to look at the VIX, V-I-X. You can follow that on your phone, and if it's above 30, that's what I call, it's basically it's the highest when you start getting into high volatility of markets, and right now it's there. And so keep that in mind. But I will tell you, there's about three different ways that you can actually help, that the Fed uses and the government can use to try to bring down inflation. And so the first one, there's three main tools. The first one is basically what we've just talked about. They've increased interest rates. And so increasing interest rates basically is creating the Fed, what I call the Fed funds rate, is the rate which banks borrow money from the government. But when they begin to borrow money, guess what? It costs them more. So guess what they do? They pass that on to you and to I. And they pass that on in the form of higher loans for mortgages, higher loan rates for cars, higher home equity lines of credit. Because it's costing them more, they pass that on to us. And that's why our rates begin to go up. And that's why it follows the Fed fund rate. So that's very, very important to understand. Well, that is now happening, and you'll begin to see, as long as they're raising interest rates, you're going to begin to see those rates that we're borrowing money go up as well. That's one way that they do that. The other one is the reserve requirement. And this is a second tool that is used to increase reserves in regards to the amount of money banks are legally required to keep on hand to cover withdrawals. I'm going to read this so I'll make sure that we have this clear to you. The more money banks are required to hold back, the less they have to lend to consumers. If they have less to lend, consumers will borrow less, which will decrease spending. The other one is the one we're in the middle of right now, and that is, we thought in May that they were going to begin to reduce the money supply. So what do you mean, Mark, by the reducing the money supply? Basically, the third method is directly or indirectly enacting a policy that encourages the reduction of money. Two examples of this include calling in debts that are owed to the government and increasing the interest paid on the bond. So what's the government been doing for months? The government for months has been coming in and buying billions, not millions, billions of dollars in treasury notes every single month. Believe it or not, they've done that in 2022 even. January, February, March, April, May. And one of the things they talk about in this interview that we have given you to look at is they are now saying in June they will come from 95 billion and they will begin to peel that back to about 45 billion. I guess my question would be, which means absolutely nothing, I guess, because they don't care what I think, but I will tell you, my opinion is that why would they keep buying and flooding the market with cash? That's been part of the inflation problem, is there's too much money chasing too few goods. Nevertheless, they're going to begin to peel that back in June. So that's another way, the third way, that they actually begin to try to tighten the money supply is by coming and pulling money back and stop buying the bonds. So I wish they would have done that. They really could have done that, in my opinion, back last year, July, and done it along the way. They could have also raised interest rates along the way. But the Fed is notoriously late to the party, late to the dance, and they become reactive versus proactive. And now they're becoming reactive right now, and that's why they jumped to a half point. First time in 22 years they've done that. They just showed their cards, in my opinion. And so that's either way, though, that is what's going on in regards to the money supply. So I want you to keep that in mind. Another thing I think I mentioned to you is the GDP this is on our last market update. GDP contracted or shrunk minus 1.4% for the quarter of January, February, and March of this year. Sam Zell talked about in that interview, he said, use the word extreme liquidity. And when you think about extreme liquidity, what does he mean by that? He said extreme liquidity has occurred since COVID in 2020. Well, you think about it just in common sense. PPP loans were given to a lot of companies to the point they didn't have to pay it back. You had many people receive not just one stimulus check, but in some cases 2 stimulus checks that were given to people. They were just mailed out, didn't have to pay that back either. So the government came in and flooded the market with a lot of cash, and that has caused a lot of inflation out there. Wages, I can tell you, they mentioned in this interview as well, are up, but they're getting eaten up by inflation. So while wages are higher, you've got inflation that's basically pulling that back. That's more for a gallon of gas, more for a gallon of milk. If you buy houses, it costs more right now for product. I've talked to home builders personally. They've talked about that as well. They can't get windows. They can't. The cost of wood is still high. Sheetrock is still high. And these are guys currently building homes right now where they're pricing in higher cost, and they don't know where that's going to end, to the point they're putting it in contracts that says if we start at this price and the price continues to escalate, you agree that you are responsible for that. That's never been done before in regards to home building, and now we're beginning to see that in actual contracts. So those things, when you throw in those things, and then you throw on top of that the supply chain, still having issues there with fulfillment. Again, home builders. I talked to one the other day. He's struggling to get windows. I can't seal the house, he says, if I can't have windows. So the house stays open. And therefore, they can't do a lot of other things inside the house until they can seal that. Go to any car lot. I took my truck in last week to get my truck serviced on a recall. Walked on the lot, and I actually had to ask, are there any new cars? And the only new cars they had at a Toyota dealership here were the ones inside the showroom. There were none on the lot. So we're still not out of the woods yet. And you think about it, markets have done a lot since 2008. COVID 2020 was an anomaly. That's why they went down as fast, and they popped back up because of the amount of money that was flooding the market, which Zell talks about in this interview. So right now we know markets are still trying to find the floors, and nobody knows where that is. What we are doing our best at is to try, as I've stated before, to not mirror that market. Here's something I want you, though, to keep in mind that I think is important for us. When we do planning with you as a client, one of the things that we try to do with every one of our clients is secure the income at retirement. Now, if you're still working, that is your income. You've got time. But if you are not working or you're about to enter retirement or you're already in retirement, one of the things you will know that we do is make sure that we're securing the income in the majority of what you are to receive. So if it's supposed to be $10,000 a month as an example, we're trying to do that through Social Security, through pensions, through annuities. Those type of things do not wobble. They provide the security of income. That's important to know, because what I want you to look at is the money that's in the market should be money that you can supplement retirement or use for later money. So ask yourself this question: am I using that money that's in the market for my retirement income? Am I actually using that on a monthly basis to where I've got to have money out of there every single month? If it is the case, then that is planned more conservatively through dividends and interest accounts. But if it's just money that's sitting over there for money that you may never use, you may pass it down to your spouse or down to your children, even to your grandchildren, or to colleges if something happens and you want to give to churches, you're going to gift that or give that to someone else. That is money that you shouldn't have to fret over every day, because your income and your base is secure. That's something I want to remind you that's very, very important, is that you understand your income should be secure. If it's not for some reason, then let us help you do that. That's our goal, and that's the first thing we do with planning. So I would strongly be surprised, I guess you could say, if that's something that we have not done that for you, because that's what we always do. We secure the income first, making sure that's your base. That's like the foundation of your house. That has to be secured, and it has to be in place, and it has to be solid. If you have that in a place that's unwavering and it's going to be there, then the money that's liquid or in the market can help keep up with inflation in the long run. You don't always see that in the short run, because markets go up and markets go down. And here's where I'll remind you, you still own the shares. You still have the shares, but they have decreased in value. That doesn't mean you've lost the money. That just means the share value is lower than it was. Just like house values go up and down as well. You still live in the house, but the value of the house may increase, but it can also decrease. Not any different with markets. Let me also remind you, because we still get people that are surprised by this, and we say it often, but I call it we re-educate you as best we can. And that is this: if you have annuities and you are pulling income streams from them, they will pay you the rest of your life. If you're single, they will pay you the rest of your life. If you're joint, they will pay you and your spouse the rest of your life, even if you take that account and it zeroes out. Hear this: it still has to pay you even if the account zeroes out. That's the whole purpose of an annuity. It's actuarially driven. And we're all practicing that every day, because people can say, well, Mark, that sounds too good to be true. You're practicing it every day, and just prove that to you right now. You think of it, you have car insurance, just like I have car insurance. Car insurance, you pay for our premium every single month. We all put premium in to the insurance companies. Insurance companies are the only ones allowed to pool all of our money together as consumers to mitigate risk for all of us. So we pay money every month in our premium for our car insurance, but we don't all get in a wreck at the same time. We pay money every single month for our house insurance, but we don't all need a new roof at the same time. Life insurance, we don't all die at the same time, but we pay our premium. Health insurance, we don't all get sick at the same time, but we pay our premium in every month. It's not any different with your annuity money. The annuity money is there, and it will pay you for the rest of your life. So it provides that security, that base. And so that's what I want you to look at, is to say, is my base secure? Is my income secure? If your income is secure, then the pressure's off on this over here. You can look at that and say, we still own it. It may be down right now. We're not mirroring the market in the down, so we're not mirroring all that carnage, but we're not using it right now. If you're still working, you don't need it right now because that's money you will use for later. You still own all the shares. And so if you've got questions on that, don't hesitate to holler at us. Call us here at the office, 1-800-381-8870. We're here to help you and answer any questions that you've got. That's what you have us for, is to be able to advise you along the way. And that's important that you use us. You're not bugging us. You're not bothering us. That's what we're here for. But part of it is to make sure that you understand we want your income stable. And we're going to, and it's what we do. We're going to make sure it's stable through the annuities, make sure it's stable through pensions, make sure it's stable through Social Security, and any other rental income or whatever else that you have coming in. Stabilize that first, and then the rest of this over here, the pressure's off of that. Hopefully this has been helpful to you. It's a little bit longer than normal, but I wanted to take the time to kind of let you know what's going on. We're not out of the woods yet. I wish I could tell you that we are. And so I have to look at that and go, okay, we're still managing the risks. We're not here to we're here to make sure that you have the income that you need. And then we're here to not mirror the markets as best we can. Right now, we've done that for the year, and that's a good thing. And we'll continue to do that. Again, thank you for your time. Appreciate you being here. God bless each one of you. If you've got questions, don't hesitate to give us a call. We'll be glad to talk with you. Take care and have a great one.